The official story of financial collapse is always the same. Greed, panic, accident, a sudden unexpected storm that wipes out the unprepared. But what if the storms are not accidents? What if they are weather events that only a select few are privy to? What if a handful of families, the true architects of global finance, possess a secret, repeating playbook that signals the exact moment the world's economic machinery will be intentionally shut down? This is the secret of the three trades. It is the universal pattern that links the chaos of 1929, the high-tech shock of 1987, the derivative madness of 2008, and the mathematical certainty of the collapse that is coming in 2025. Billionaires don't watch the markets. They watch the plumbing. They don't react to crises. They position themselves for the harvest. The history books show you the headlines, Black Tuesday, the panic, the breadlines, but they never show you the internal ledgers of the men who run the financial world. They skip over the three tactical moves that prove the elite know the demolition is scheduled. The first test of this playbook was the greatest financial event of the 20th century, the panic of 1929 and the Great Depression it unleashed. The official story says the market simply got too enthusiastic, fueled by margin debt and public euphoria. The truth is that the collapse was engineered. It was the final, devastating move in the Jekyll Island plan, a calculated consolidation of power designed to eliminate the cartel's competitors and buy up America's assets for pennies on the dollar. The elite knew the trigger, the Federal Reserve, contracting the money supply because they controlled the trigger. And their moves, in the months leading up to October 1929, were the first perfect execution of the three trades. Trade 1. Liquidation. Selling the illusion. The entire financial system is an ecosystem of risk. The public flocks to the highest risk, highest reward assets during a boom. Speculative stocks, housing, or junk bonds. These are the assets built on pure euphoria, offering the illusion of infinite gains. The first trade of the elite is simple. They get out of the illusion. In 1928 and early 1929, while the market was climbing vertically, the big houses, the Rockefeller interests, the Morgan Empire, and the established investment trusts did not join the frenzy. They were silently, systematically exiting the volatile equities market. They were not just selling, they were liquidating the risk from their balance sheets and moving the proceeds into the safest, most stable position available, cash and short-term treasury instruments. This is a key signal. When the cartel, which has access to unlimited credit, starts hoarding cash, it is a terrifying sign. It signals they know the value of credit is about to disappear, and only physical liquidity will matter. While the public was borrowing on margin to buy radio stock, the insiders were buying bonds that guaranteed payment from the government. They understood that when the house burns, the one with the cash can afford to walk away, and the one with the cash is the only one who can buy the ashes. The selling was done quietly, spread across different accounts, filtered through different funds, ensuring the public ticker tape showed nothing but continuous, optimistic assent. The illusion was maintained until the very last moment. Trade 2. Acquisition. Buying the truth. The second trade is the pivot from paper wealth to real wealth. When the elite exit the market, they don't leave the money under a mattress. They deploy it as a firewall against the coming storm. They move into assets that cannot be printed, cannot be manipulated by central banks, and will be essential in the economic aftermath. In 1929, this trade manifested as a massive acquisition of gold, land, and monopolies in essential services. The elite knew the coming crash would be a deflationary event, but they also knew that in the chaos, the value of tangible assets would eventually surge past paper wealth. During this period, the major industrial houses were heavily increasing their ownership of natural resources and utilities. They were buying up vast tracts of land, farms, timber, and mining rights. These assets are non-negotiable. People always need food, light, and heat, regardless of the Dow Jones Industrial Average. But the ultimate truth asset, the ultimate hedge against central bank manipulation, has always been gold. While the Federal Reserve was busy trying to manage the gold standard, the very constraint they hated, the private banks were quietly amassing physical gold reserves. They understood that the Federal Reserve, the creature from Jekyll Island, had to contract the money supply, that painful process of austerity, which would increase the real value of the remaining assets, especially gold, once the dust settled. The public held paper. The elite held the physical foundation of wealth. This trade ensures that the elite's purchasing power not only survives the collapse, but dramatically increases when the assets of the ruined are put up for sale. Trade 3, leverage, betting on the break. The third trade is the most cynical. It is the calculated act of placing a massive leveraged bet against the stability of the entire system. This isn't insurance. It is a weaponized bet that guarantees the crash will not only happen, but will also provide the ultimate profit. In the 1929 era, the technology for this bet was crude, but the principle was absolute: short selling. The elite used short positions, selling borrowed stocks they believed would drop as a way to bet against specific sectors that were most inflated or against the overall market. However, the deepest leverage trade wasn't just against the market, it was against the system. The real leverage was held by the institutions with political knowledge. They understood that once the Federal Reserve, the creature they controlled, decided to pull the brake, the collapse would be total and unrecoverable. They timed their short sales and liquidations to coincide with the prearranged tightening of credit by the Fed. The public's loss of faith and the subsequent panic was merely the fuel for the fire. The trades were the match. The pattern was set. The three trades ensured that the powerful did not participate in the devastation, but instead they maximized their capital reserves, hedged their risk with real assets, and profited from the destruction itself. The crash was not a failure of capitalism. It was a scheduled event, executed by the architects of the system to facilitate a massive, calculated harvest of the nation's assets. The three trades worked, but in the next collapse, the mechanism would become faster, the stakes would become global, and the scale of the deceit would become technological. The 1987 collapse, known as Black Monday, marked the technological acceleration of the playbook. The official story of Black Monday is that it was a technical glitch, a catastrophic, unexpected failure of program trading, a sudden domino effect triggered by portfolio insurance, and computer-driven selling that plunged the Dow Jones Industrial Average by 22.6% in a single day, the largest single-day percentage drop in history. The textbooks frame it as an accident, an anomaly. The truth is that the three trades were executed faster, bigger, and more ruthlessly than ever before, using technology as the ultimate weapon of concealment. The crash was the predictable result of the decade's unchecked financialization, and the billionaires were simply getting out, using new mechanisms to amplify their exit. The real cause wasn't the code, it was the pattern. In the years leading up to 1987, the U.S. economy was addicted to debt, just as it had been in the 1920s. The Reagan administration was running massive deficits, and the dollar, unchained from gold since the 1971 heist, was floating in a volatile sea of fiat currency. The financial elite saw the writing on the wall. The system was mathematically unsound, and a hard landing was inevitable. Trade. 1. Liquidation, the coordinated exit. In the months leading up to October 1987, the elite's trade was not just about selling. It was about moving from the volatile equity casino and back into the ultimate safe haven, U.S. government long-term Treasury bonds, T-bonds. This is the key distinction from 1929. In the modern fiat system, the deepest layer of safety isn't a T just cash. It is the promise of the government that prints the cash. T-bonds became the preferred vessel for institutional flight capital, large hedge funds and institutional asset managers. The modern-day equivalent of the Morgan and Rockefeller trusts began a massive, quiet rotation out of stocks and into T-bonds. This wasn't because T-bonds offered high returns. It was because T-bonds represented the highest degree of safety and liquidity when the global financial system faced an imminent liquidity drought. The liquidation was so effective that by October, the selling pressure built up by the elite's rotation was poised like a loaded spring. All that was needed was the trigger. Trade 2. Acquisition. The global hedge. In 1987, the acquisition trade was not just buying land, it was buying a hedge against the inevitable collapse of the U.S. dollar, which was at the core of the debt bubble. The elite moved into globally diversified, non-dollar denominated assets. This manifested as a massive flow of capital into Japanese and German real estate and equity markets, as well as a significant increase in the acquisition of physical gold, which had been re-legalized for private ownership in the 1970s. The billionaires understood that the 1971 heist had turned the dollar into a weapon. They recognized that the U.S. economy's ability to run limitless deficits meant the currency was inherently unsound. Therefore, their hedge needed to be global and tangible. The acquisition of global real estate and foreign equities served as a powerful firewall, ensuring that their capital not only avoided the domestic devastation of the impending U.S. market crash, but also positioned them to profit from the recovery of foreign markets. The trade was simple. When the center of the financial world, Wall Street, collapsed, their money would be parked in Berlin and Tokyo. Trade 3, leverage, the future's bet. This is where the 1987 collapse fundamentally changed the playbook. The third trade wasn't just a manual short sale. It was the technologically enabled catastrophic bet known as portfolio insurance and index futures selling. Portfolio insurance was a complex strategy that involved using computerized models to sell index futures, bets against the market as the market fell. This was designed to insure large portfolios against losses. The elite didn't just use portfolio insurance, they amplified it. They had the earliest access to the most sophisticated algorithms. By loading the system with massive pre-programmed sell orders linked to market indicators, the billionaires ensured that once the market dipped, The automatic selling would not just mitigate their losses, it would force the crash for everyone else. The technical anomaly that caused the 22.6% drop was the direct and intended consequence of the elite AS leveraged bet. It wasn't a glitch, it was the preset technological mechanism for the liquidation event. The 3 trades of 1987 proved that the pattern was adaptable. The crisis was not caused by irrational panic, it was caused by rational, calculated selling amplified by technology. It accelerated the exit, maximized the profit from the crash itself, and solidified the elite's position at the expense of every retail investor caught in the machine-driven panic. The pattern would now lie dormant for 2 decades, gathering immense energy for its most cynical and profitable execution, yet the ultimate deception of 2008. The 2008 financial crisis was the ultimate proof of the playbook. It wasn't just a market crash, it was a systemic demolition that revealed the elite had moved from merely anticipating collapse to manufacturing the poison and then betting against their own creation. The official story of 2008 is that it was caused by reckless lending and greedy homeowners. The textbooks talk about subprime mortgages and the failure of Lehman Brothers. The truth is that the 3 trades were executed in a sequence of shocking cynicism that amounted to a betrayal of every client and every public trust. The banking cartel, the architects of the fiat system, understood that the debt was toxic because they were the chemists who mixed the poison. Trade 1, liquidation, selling the poison. The liquidation trade of 2008 was a breathtaking act of deception. Unlike 1929 or 1987, where the elite merely sold their stock, in 2008, the investment banks were aggressively selling the very toxic debt, mortgage-backed securities, they were secretly calling junk. Institutions like Goldman Sachs, Deutsche Bank, and others were creating exotic, highly rated mortgage products, dubbed CDOs, collateralized debt obligations, and pitching them as safe, stable investments to pension funds, city councils, and foreign banks. But at the exact same time, the elite were making their trade 3, the leveraged bet against these assets. The liquidation involved offloading the riskiest assets from their own balance sheets onto unsuspecting clients. They liquidated their risk, but maintained their relationship with the asset through their leveraged bet. They were not just exiting the illusion, they were making sure the public was fully invested in the lie before the curtain fell. Trade 2, acquisition, the too big to fail. Hedge. The acquisition trade of 2008 was a sophisticated hedge against the inevitable government intervention. The elite knew that once the collapse hit, the government would be forced to inject trillions into the system to prevent a total systemic meltdown. Their primary acquisition was cash and high-quality U.S. Treasury securities, T-bills, guaranteeing their ability to access the Federal Reserve's emergency window. This cash hoard meant that when the government enacted the $700 billion TARP bailout, the large banks were the only institutions with the liquidity and the quality of assets necessary to participate. They acquired the bailout cash, repaid their debts to the Fed, and immediately positioned themselves to acquire failing regional banks and assets at fire sale prices once the panic subsided. The too big to fail mechanism was, in fact, the ultimate acquisition trade. It was a guarantee that the elite's capital would be protected, synthesized, and multiplied at taxpayer expense. Trade 3, leverage, the CDS payday. The third trade of 2008 was the most effective weapon in the playbook, credit default swaps, CDS. A CDS is essentially an insurance policy against default. John Paulson, among others, famously made billions by taking out massive CDS positions against the very subprime mortgages he knew were certain to fail. This was not insurance. It was a pure, highly leveraged, catastrophic bet. The money was paid out by unsuspecting institutions like AIG, which had no concept of the total systemic risk they were undertaking. The CDS trade acted as both a predictor and an amplifier of the collapse. By placing these bets, the elite ensured they would profit from the total destruction of the assets they had just finished selling. The scale of these bets was so large that when the defaults started, the payout mechanism, the CDS market, failed, pulling down the entire global banking system. The 2008 crisis proved that the 3 trades had evolved from a passive exit strategy into a proactive financial weapon. The billionaires didn't just escape the crash, they were the executioners who profited from the resulting systemic chaos, paving the way for the inevitable final collapse that is now gathering pace. The pattern is repeating. The cycle is absolute. From the excesses of the 1920s, the panic of 1987, and the engineered failure of 2008, the signs are now undeniable. The 3 trades are being executed in real time, signaling that the architects of the system are preparing for the final ultimate collapse. The current environment is one of unprecedented terminal debt. Central banks have engaged in trillions of dollars of money printing, quantitative easing, ballooning their balance sheets and devaluing the fiat currency at a speed that is mathematically guaranteed to end in failure. The 1971 gold standard heist has reached its natural conclusion. The collapse that is coming, the 2025 event, is not a cyclical correction. It is the necessary controlled demolition required by the elite to wipe the global ledger clean and usher in the final phase of their control, the Great Reset. Trade 1. Liquidation, the Great Exit. The current liquidation trade of the elite is visible in a massive, quiet shift out of the last highly leveraged sectors of the market and into ultimate safety. The money is flowing out of commercial real estate, CRE, highly speculative technology stocks, and leveraged corporate debt. The elite are selling the skyscrapers and the phantom companies built on cheap, printed money. Where's the money going? It is going into ultra short-term U.S. Treasury bills, T-bills. This is cash that yields interest, but is immediately accessible. It is the ultimate liquidity hoard. When billionaires start demanding safety over yield, it means they foresee a liquidity drought so severe that only T-bills will remain sound. They are hoarding the life raft. Trade 2. Acquisition. The firewall against fiat. The acquisition trade today is the most blatant repudiation of the fiat system since Charles de Gaulle demanded U.S. gold in 1965. The elite are not acquiring foreign stocks. They are acquiring the hard assets that guarantee survival when the dollar collapses. This is seen in the unprecedented, historic, global central bank acquisition of physical gold. Central banks are dumping U.S. dollar reserves and replacing them with the one asset that cannot be printed, sanctioned, or defaulted on. The private acquisition trade is focused on tangible utilities and land. The elite are acquiring vast tracts of farmland, water rights, and essential energy infrastructure. They are building a physical firewall against the hyperinflationary destruction of the currency. They are buying the assets that maintain value when the fiat money becomes worthless. Trade 3, leverage, the CBDC bet. The final trade for the coming collapse is not merely a short position against the stock market. It is a leveraged bet on the destruction of the current banking system itself, paving the way for the elite's new mechanism of control. The leveraged bet is the move into central bank digital currency, CBDC architecture. The elite, who control the central banks, are aggressively promoting the CBDC as the inevitable solution to the instability they created. This is the ultimate leveraged bet because it guarantees that when the commercial banking system fails, the public, broken, bankrupt, and desperate, will accept the elite's single digital programmable currency as the savior. The three trades confirm the final cycle. The liquidation ensures the elite escape the crash, the acquisition ensures they survive the ensuing hyperinflation, and the CBDC bet ensures they profit by replacing the old cage with a new, stronger, digital one. The trades are the evidence. The pattern is absolute. The elite are out of the market. They are holding the gold, and they are preparing the digital cage. The collapse of 2025 is not an accident. It is the final profitable harvest of the system. The architects of the collapse are making their final move.